Hey all, this is my take about yesterday's plunge in technology stocks, mainly US equities, and the Fed meeting, as well as what this may mean for Chinese equities. So I brought up this chart here, and what you can see is the Invesco Golden Dragon China ETF. So that is this chart. As you can see, it has peaked in February and then had a very big sell-off after all of the bad China news, 60% down. Until today, now going into 2021 basically at levels similar to March 2020 when the COVID crisis hit, or previous lows. In comparison to that, you'll see the Nasdaq here, which is the US technology stocks, which yesterday had a very sharp down day, as you can see. And that was mostly about the fact that the Fed had a very hawkish meeting, indicating earlier rate hikes, quantitative tapering, so a scale back of asset purchases, and in general, less liquidity in the market. And we've seen similar stuff after February last year, when suddenly the 10-year yield was rising as the bonds been sold off. So asset managers seem to be allocating some of their assets more towards risk-free assets where they can still get a yield now if the interest rates are going to rise in the future in order to fight inflation. So this is what the Fed has been signaling. And this is of course not good for technology stocks, and usually has the effect that the multiples, so the price to sales ratios, are shrinking. So we have this new macroeconomical environment here that now in the US part of the world will be a less liquid market possibly. So in general, possibly seeing a tightening, whereas in the other part of the world, in China, actually the opposite is happening. So China in the last couple of weeks has announced several ways of helping the economy with stimulus, with more liquidity in the market, and also the real rates in China, so the interest paid on debt, actually is much higher than anywhere else in the world actually. So this is giving the Chinese regulators here, or the Chinese economists, more space to actually help the economy by doing what the Fed is now doing in the opposite way of decreasing the rates. And I think we also see the first signs of that. For example, NIO has just announced that they are offering to buying back some of the convertible notes that have issued that are due 2024 and that have quite a high yield. So initially when NIO issued those convertible bonds, they had a strong need for financing, and they would be willing to do this at a quite high interest rate. But now NIO has a good cash position. They are also at the brink of profitability. And on top of that, I think what they're seeing is that they could possibly refinance this convertible bond at a lower rate here, possibly. For example, if China were to use their monetary policy and reduce rates even further, they could just take out a normal bank loan, because also one of the drawdowns from a company side here from those convertible notes is actually that the bondholders can actually choose to get shares instead of being paid back. And so by repurchasing those bonds, NIO is actually also decreasing the float, so less shares outstanding. And so you can see for companies that are mainly operating in China, which have their business there, and also are more likely to get like their financing than in China for a normal debt tool, then they can now possibly in the future really benefit from that. China is now entering a phase in which there will be more kind of an easing policy, more economic support from the government for keeping the economy up and growing, while in the US we'll see possibly the opposite to happen. So are we going to see more of a shift from US assets into Chinese assets here? Well, this is hard to say, because most of these companies included in this Invesco Golden Dragon China ETF are, for example, the biggest position here: Baidu, Alibaba, NetEase, NIO, and JD.com. And so the unfortunate issue here is somewhat that while the operations of these companies is all in China, they may actually be victim to the US markets here, because these are perceived risky assets and they are technology stocks, so they should usually see a multiple contraction, meaning people are willing to pay a lower valuation only in such kind of an environment. and maybe people are not really paying attention to the fact that these companies will actually not be hit that hard on the bottom line of the business with increased refinancing and such. But on the other hand, one could argue that those companies in this basket here have, of course, already seen a huge multiple contraction, so they are priced much, much lower. Some of the companies that I'm covering that are in such kind of an ETF are already priced at their price to book ratio, so meaning all of the assets of the company are actually reflected in the enterprise value, like cash and the assets, and there is almost no goodwill for the future returns of these companies. So one could argue, yes, smart, intelligent fund managers should actually see that these technology stocks have been discounted already. And it was interesting to see that yesterday also Baba was one of the only green companies out there in a sea of red here, because Munger decided to double down on its Alibaba investment. As a disclosure, I'm not invested in Alibaba, but in general this may send a positive message there towards the whole Chinese sector. Maybe some other investors are going to jump on the bandwagon. I think such an ETF like the Golden Dragon China ETF should be quite interesting right now, because you don't actually have to pick a winner, like which company in China will possibly recover quickest or outperform, because it's diversified risk. And also fund holders can actually hold this US listed ETF there without having to worry about that the companies are moving to Hong Kong and then they cannot own it directly in the portfolio. Instead, they can just own this ETF. And personally, while I'm not holding this ETF, I outlined to my patrons already last year that I've taken some profits of some of the US equities and also in the crypto space because of this monetary environment, which is, right now really not in the favor. We'll see. We'll have more Fed meetings and more clarity towards this also. But personally, last year I made the choices to make huge changes to my portfolio, and now also having quite a bit of a cash position where I'm now kind of observing and looking where will be my next moves in this kind of more uncertain and skittish environment here when it comes to the US markets in particular. For NIO in specific, well, NIO has one of the most discounted price to sales ratio already, so very compressed multiples in comparison to some of the industry peers, and a big 2022 upcoming in terms of the sales growth in my point of view, and quite good fundamentals in terms of the cash position, as well as being at the brink of profitability. So there shouldn't be a big risk in terms of that this company would go bankrupt in case that these kind of financial conditions are turning negative here from a company perspective. So the fundamentals of the company are good, and in the long run this won't really matter to NIO that much. Of course it can cause drawdowns like yesterday. However, as outlined in this video, it seems that some of the drawdowns have been possibly exaggerated, particularly in Chinese names. I know the sentiment for Chinese stocks in general is still very low. However, maybe more and more investors are waking up also to the arguments that are brought here on the channel regarding the crackdowns and implications on the company, regarding the legal implications of the VIE structure, Chinese stance on that, and many more things like that. It seems like people like Munger are not impressed by those kind of fear, uncertainty, and doubt stories, but I think it also needs some of the retail investors to come back and getting more trust into China again. This can certainly take some time, but I'm just laying out the facts here. You guys have to decide for yourself and then see whether or not you can front run the Chinese investors from mainland coming when the Hong Kong Stock Connect has been established, and also maybe funds getting more bullish on China again. So thank you guys for watching. Please leave a comment and a like, and then see you in the next one.